We have Lutfey Siddiqi of UBS, a voice that matters as far as emerging markets are concerned. Thank you very much for being with us. The world is seeing a lot of financial turmoil and markets are no exception. I specifically want to ask you, do you see this as the same turmoil in 2008 or is this a different turmoil considering monetary policy in the last 8 years hasn't been able to rev up growth all around the world?
Well, we're constructive. We're constructive on the world of macro investing. But I would say moderately and modestly so rather than euphorically so. Mm-hmm. And if you do a sweep of the world, start with the US, Europe, both of which sequentially are looking stronger, but the wild card is clearly China and what that means for emerging markets.
So I'm going to speak to you about China in just a bit, but I specifically want to ask you on emerging markets as a basket versus the developed markets. And you rightly said that US and Europe are beginning to go. It's emerging markets that will be a pressure point, that will be a pain point. What is your outlook on emerging markets all through 2016?
So if you zoom out of the typical markets horizon and talk about the theme of Davos this year, which is the fourth industrial revolution,
that's right.
There's clearly something massively structural going on. And we believe that on the margin, the fourth industrial revolution would benefit developed markets more than emerging markets. And at the risk of oversimplifying it, what that means is that low-cost labor doesn't provide an economy as much of a relative advantage as it used to do in the past. And there are things that can be done about it, but that is in the backdrop a structural headwind for emerging markets. From a market's point of view, the immediate question is, and again, emerging markets is a mixed bag, different countries have different profiles, but one way of looking at it is that if you as an emerging economy are selling into China or any economy where they're not buying as much as they used to, so that determines your earnings.
That's right.
And are you borrowing in US dollars and US rates are about to go up? The US dollar is expected to strengthen. So are you stuck in a bit of a double whammy where your earnings are potentially impaired and your cost of funds are potentially rising? And the combination of the two provides challenges.
So you're essentially saying here that weak growth domestically, weak exports, a currency mayhem, this is structural pain in emerging markets.
It's a structural pain. The growth model needs to change. The sources of growth, the engines of growth need to change. Western economies, the kind of growth that the US is exhibiting, are not as kind to emerging markets as it used to be. Right. So trading out of slow growth, exporting into Western economies as the sole engine of growth is going to be challenged. Whether that's finished products, electronics and so on into the Western markets, or commodities into China, which has historically been the largest marginal buyer.
Just want to pick your brains on the whole risk aversion bit as far as emerging markets as a basket is concerned. And I specifically want to talk to you about the fact that do you see this as a prolonged risk aversion period or do you expect this to subside and at what period?
So risk aversion is not just about emerging markets. There are lots of uncertainties right now. And part of it, again, goes back to the fourth industrial revolution backdrop, which is really multiple revolutions happening at the same time. Changes to economic systems, technology disruption, social systems, political systems, belief systems being challenged. And so there's lots of uncertainties around. Globally, there is a very strong disinflationary trend. On that backdrop, in emerging markets, you could look at a few factors when you assess a country. You could look at how much fiscal space do they have. If they happen to be oil importers, then this has been a great advantage, a period of opportunity for them.
Right.
Fuel subsidies are down, current account deficits narrow, so that's been good for you. If you're an oil producer, so the government relies on income from the oil sector, then this has been a negative for you. So how much fiscal space do you have is one. How much leverage do you have in the system? One of the observations the last few years is the US has done a very good job of deleveraging. The private sector is delevered, whereas emerging markets by and large has levered up. So how much space do you have from here on to jack up credit? And then how much of that credit is from the external sector? How much of foreign currency debt is due in the short term? And then lastly, perhaps the most crucial point is what is the outlook for structural reforms in your respective economies? And structural reforms have a political dimension political economy dimension to that. And there the outlook is different for different countries.
I want to specifically talk about India because you mentioned that the value of oil and, its repercussions. India is, of course, an importer, and our fiscal deficit has contracted. I mean, should have contracted on account of it, but we're trying to push up spending. How do you see India amidst this entire sell-off? I mean, everybody talks about this being as a shining spot, but as somebody who is invested and has their skin in the game as far as emerging markets are concerned, are you as optimistic about India right now?
Yes, so India remains a watching brief. It has all the... there's the window of opportunity, both in terms of what it can do internally and also the external environment. Amongst most emerging markets, the linkage that India has to China, or the dependence to a slowing China, is actually a lot less than others.
That's right.
So it's insulated in many ways. Domestically, there's a lot to do. There's infrastructure work that needs to be done. India's doing a great job of bringing inflation down structurally, of course helped by low oil, but I think between the central bank and the government there's clearly been positive action taken there. But structural reforms is not something that happens overnight.
That's right.
And it needs to be something that we watch, particularly the political economy dimension of that.
I also want to speak to you about the currency because there's a lot of pain that we're beginning to see in the rupee. It was reasonably stable all across this period, but now it's breached levels of 68, gone back to the levels of 2013 when the taper tantrum was first discussed and breathed about. How much of a pain do you see in emerging market currencies? And that brings us to the whole dollar dilemma. We are letting the dollar appreciate, but look at what it's doing to the rest of the world.
Yes, so the dollar is, I think, on a secular uptrend against emerging markets. But India hasn't really depreciated as much if we compare it to, say, Brazil, which dropped by about a third last year.
That's right.
Or the Malaysian ringgit, which dropped about 20%, or the Indonesian rupiah by about 10%. INR was 5% or so last year, and then, of course, some more in January. There's probably more to go. I think the issue with emerging markets currencies depreciating, particularly in a disinflationary world, is not so much whether they're going to depreciate, it's whether they're going to depreciate in an orderly manner or in a disorderly manner.
That's right.
And it's the disorderliness that spooks markets more.
So what's your take on the rupee? Is it depreciating in a disorderly manner or in an orderly manner?
So far it's been fairly orderly, particularly if you compare it to what's been going on elsewhere.
What's your call on investments in India? We have a new government, people very euphoric about it. Then, of course, the reform drive did slow down. We've, of course, seen inflation taper down considerably. What are the factors that investors are looking at while investing in India? Infrastructure still remains a big sore point, does it not?
So, in the short term, it all depends on valuations, asset class by asset class. But if you take a step back and think about what are the strategic drivers, the long-term drivers, India has, in theory, very sound demographics. The World Economic Forum publishes a competitiveness index. We cross-reference that to what we think would be drivers of success in the fourth industrial revolution. And having a young population is clearly useful. But together with that, infrastructure is useful, and what you do with your population is also important.
Right.
The education levels, the type of education, is it the adaptive type that allow people to move around? Labor market reforms, is it dynamic? Can you switch jobs? And when I say infrastructure, it's not just hard physical infrastructure, but also the soft infrastructure.
That's right.
Around legal protections and so on and so
Contract
forth.
obligations and things like that.
Yes.
I want to speak to you about valuations because that's something that you mentioned in passing. What's your call on valuations in India, and when do you see these bottom out?
That's not for me to comment on.
All right, let me move on to China because that is really the elephant in the room that everybody here in Davos is essentially talking about. Are you a believer in the China story, or are you somebody who believes this isn't transition but this is mess? I mean, those are the two sides of the spectrum. Many people believe we do not know what's happening in China, so it is in a mess, and other people believe this is an economy in transition. There's some amount of political will behind it. It's an economy in transition. What do you believe?
I'm in the transition camp. It's clear that China has an execution challenge. What China needs to do, in theory, is clear, and there's probably no debate in that. They need to rotate the engine of growth from fixed asset investments more towards consumption and services. But as you make that rotation happen, you still need to keep some credit in place, particularly given that there is enormous overcapacity in the construction and property sector. And so that overcapacity needs to roll off. And while that happens, they will need to manage financial conditions in that process. Disinflationary forces are a side effect of excess capacity. Producer prices have been going down. And I guess we've seen these short spikes, short movements in the stock market and in the currency market, but I think it doesn't derail the execution process that they're part of. The question there, I think, is less about whether China will cope, whether China will be all right. It's really whether the rest of the world will be all right.
Yes.
You could have a soft landing in China and a hard landing in those who sell to China.
That's right.
Because a byproduct of rotating away from heavy investment type of growth is that you buy less of the commodities from others.
While we were talking about China, I want to ask you, what is the kind of, many people fear that China may in fact export deflation to the world. So that's question number one. And question number two is there's so much debate around the yuan. I have two questions there and two questions on both ends of the spectrum. The first question is, what is the extent of devaluation that can still happen according to you? And what does this mean for the other emerging market currencies? And the larger question also is that going forward, given the dollar dominance, you think yuan can ever get to that position?
So, we think that the yuan will depreciate further, but perhaps not as dramatically so as many others feel. Probably another 5% depreciation, 680 against the dollar or so. We also know that it's being managed against an index, a basket, as opposed to just the dollar. But if we're wrong, if it turns out that the yuan depreciates further, then it adds to the pain in some other emerging markets. Because China has multiple roles in the global economy.
That's right.
On a $11 trillion size of GDP, 6% growth, 6.2% growth is still adding more in dollar terms than 2.8% growth in the US.
That's right.
But as I said, China has different roles, one of which is that it's a demander of stuff from other emerging markets, but it's also a supplier of stuff to Western economies.
That's right.
And in a world where the currency depreciates much further, which is not our base case view, but if it were to happen, then China starts competing with other emerging markets.
That's right.
That makes it harder for others.
I have one last question before I let you go. Optimists in India believe here is this great opportunity. China is slowing down and we can shoulder some part of that global growth engine. Of course, more rationalist speakers like Raghuram Rajan believe that's far off the mark because our economy is just so much smaller in size. If I were to ask you that question, from how you see things expanding both in India and our neighbors across the borders, that's China, what is an opportunity that you envisage for India? Are we anywhere close to shouldering that big global engine growth title that China, of course, has come to attain in all these years?
India has the enabling factors to have growth for some time. When we talk about structural reforms unlocking potential growth, in the case of India, it's in theory easy to identify what those reforms need to be. In many other countries, in parts of Europe, for example, it's not as easy to see what more can you unlock. And so where will growth come from? In the case of India, growth can come from many different sources. So it's latent, there's potential, but it needs to be actualized.
So as someone with the money bags, like you said, it's easier to identify the reforms in India. Which ones are the ones that you would want to go through? And there is a bit of a political standoff on some of the tax reforms like the GST, which is beginning to worry some investors here in Davos. Do you share that concern? And what would you want the government to do over the medium to the long term?
I think bringing inflation down structurally is a major act of success, and that's happened or is happening. And there are other steps being taken, automation of some of the government processes. So there's a laundry list. And this is not just an India problem. There's Abenomics in China, which is a laundry list of third arrow. Everyone in the world needs to engage in structural reforms. Some have the political will to do so, and some others don't.
Mr. Lutfey Siddiqi, it's a pleasure talking to you. Such a great time to be here on ET Now and talking to us about emerging markets, specifically India.
Thank you very much.
That's Lutfey Siddiqi of UBS in conversation here with us at Davos on ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.